Imagine this. A government announces it's printing money. People panic. Headlines scream inflation. But behind the scenes, something much bigger just happened. No new bills were printed. No trucks of cash. No vaults filling up. Instead, a number changed on a balance sheet, and that number, debt, just became more powerful than money itself. That sounds dramatic. It should, because the modern financial system doesn't really run on money anymore. It runs on promises, IOUs, obligations stacked on top of obligations. And once you see how that happened, you start to realize why the system feels unstable, even when everything looks fine. Let's rewind. For most of history, money was simple: gold, silver, coins, physical things. If you didn't have it, you couldn't spend it. Debt existed, sure, but debt was smaller than money. Debt was a side note. Then something flipped. Fast forward to the 20th century. Wars got bigger, governments got bigger, and suddenly there wasn't enough money to pay for everything. So governments borrowed, banks lent, and everyone agreed to sort it out later. That later never came. Instead, debt became normal, expected, permanent. By the 1970s, most major economies quietly accepted a new rule: we will never fully pay this back. And that's where things get interesting. Today, there is far more debt in the world than money. Not a little more, wildly more. Global debt is over $300 trillion. Actual physical cash is a tiny fraction of that. So how does that work? Simple version: money is created when someone borrows. When a bank gives out a loan, it doesn't hand over existing money. It creates new money on the spot as debt. Your mortgage? New money. Business loan? New money. Government bonds? New money. Money enters the system already owing something, which means the system doesn't grow by saving. It grows by borrowing. That's the first uncomfortable truth. The second one is worse. When debt creates money, it also creates a clock, because debt comes with interest, and interest means more money must exist in the future than exists today. But where does that extra money come from? More borrowing. This is the loop. Debt creates money. Interest demands more money. More debt creates that money. Stop the loop and everything tightens. Credit freezes. Businesses stall. People lose jobs. So instead of debt being a tool, it becomes a requirement. And over time, it starts calling the shots. Here's where the power shift happens. Governments used to control money directly. Now they manage debt markets. Central banks don't ask how much money should exist. They ask, can the system service its debt? Interest rates rise too fast, debt becomes unpayable. Markets panic. Interest rates stay too low, debt explodes anyway, just more quietly. So policy stops being about prosperity. It becomes about balance, keeping debt alive without letting it collapse. That's why bad news is often good news for markets. A weak economy means lower rates. Lower rates mean cheaper debt, and cheaper debt keeps the system breathing. It's a strange irony. The system needs growth, but it also fears it. Now zoom in on something even stranger.